where I see a lot of people make mistakes is they get caught up in a financing scheme or a mechanism or an interest rate. And what really drives the deal is not the fundamentals. It's not good real estate that's near jobs, it's near transit and supply constrained markets. It's driven by a financial structure. It's driven by some deal that somebody can get. Financial structures are very easy to replicate. I think as long as investors and developers and operators keep focusing on fundamentals, I think you'll make better decisions.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast series, Real Estate Market Watch, current events through a real estate lens. My guest today is Sean Burton, who is Chief Executive Officer at Cityview. Cityview has invested approximately $6.5 billion in more than 150 projects across the country and has operated and developed nearly 20,000 units spanning 15 markets, all multifamily, across different types of multifamily, from value add to ground up. Our conversation starts with what capital partners are looking for today. Capital partners, in Sean's case, being typically institutional or ultra high net worth family offices. What are they seeing, and what is debt doing in the market today? How is debt behaving and how is equity behaving? And what are their view of the market? We also discuss Sean's prognosis about where the economy is going, at least the commercial real estate world, and what we can expect in 2026 and beyond. And we chat a bit about the issues that are facing supply constrained markets and also markets that have excess supply for housing, particularly multifamily, and what both local governments and the federal government can and cannot do to help stimulate solutions to the housing crisis in America. Sean is one of the foremost professionals in the industry, and you're going to learn a lot from our conversation today. Please go to GowerCrowd.com if you've not already done so, and subscribe to my newsletter. I provide summaries of these fabulous conversations, actually, that I have on the podcast, as well as some tips and tactics that you can apply to your capital raising efforts today, and also how you can lean into AI for the future. All right, all there at GowerCrowd.com. All right, let's get on with it. Sean Burton, CEO of Cityview, coming right up now. Sean, what a pleasure to see you again. Thanks so much for joining me today on the podcast. Let's open up, if you don't mind. Tell us who Cityview is. Give us a sense of scale and scope, and what you guys do.
Sure. First of all, Adam, thank you very much for not just having me, but having me back. It's good to be back. I'm a big fan of your podcast. So Cityview has been around for 21 years, and we are based here in Los Angeles, but national in focus. We also have offices in Dallas and New York, and we basically focus on multifamily. We buy existing multifamily, we operate multifamily, and we build a lot of multifamily. We've done over kind of 20,000 units since we started the firm. We have been heavy in kind of the West Coast markets, particularly where you have a lot of job growth and not a lot of new supply. But we're also in Denver and Dallas and then, kind of focusing on the East Coast as well. So that's what we've been doing. We're fully vertically integrated. We, do all the development ourselves. We do all the construction management ourselves, all our own property management. So we are a fully integrated owner operator focused on housing.
Didn't you used to do JV partnerships with sponsors? I had this vague recollection that you used to. I remember talking to them.
That's a great memory. The first few years of the firm, we were a capital allocator. We would raise public pension money in funds or separate accounts. And then when the great financial crisis hit in 2008, we ended up having to take a lot of properties back from different operators and developers. And we frankly realized that we just weren't close enough to the real estate. So we made a decision then to really invest in the platform and vertically integrate, and started by building out a development team. And then once we figured that out, we built out the construction management function. And then in about 2018, launched the property management function. So It took us kind of a decade to build to the team we have, but we now have over 200 people
Oh
focused,
my God.
on buying and managing and running these assets.
Hmm. And who are your typical, not specifically by name unless you want to share them, but what are the characteristics of your typical capital partners these days?
So, we're kind of an interesting hybrid firm. So we have a series of traditional kind of commingled fund vehicles where we have discretionary capital, and we have large public pension funds, both public and private in that, family offices. We have some foreign investors as well.
Hmm.
But then in 2010, we did a major recapitalization of one of our pension system partners, and we started a kind of a joint venture relationship and joint venture business. And
Hmm.
that was a big partnership we did with Blackstone. We've done a lot with them since. And I don't know, we have about a kind of a dozen large joint venture partners that we work with. And we often partner them with our commingled funds. We'll often, that's been a very kind of attractive structure to
Hmm.
folk because we kind of flow all of our deals through that. Look, we've been very fortunate. We've had wonderful capital partners, and they've had capital in good times, and even more importantly, they've had capital in more challenging times. We've been able to pick up distressed assets and take advantage of, buying at a low basis. So it's a lot of work, but we're blessed with a lot of good capital partners and a lot of repeat capital partners.
Okay, perfect. Teed me up perfectly for my next question, but I'm going to interject another one in the meantime. You did mention foreign investors. Whenever anyone says that, I always ask, none from Japan by any remote chance?
We don't have any investors from
Mm,
Japan today, but we probably should. If you look at the character of Japanese investment in the U.S., they're doing kind of
mm.
exactly what CityView does. So we actually have a pretty robust capital raising plan in 2026. We're going to be spending a fair amount of time in Asia. We'll also be
Really?
in the Middle East. We're going to be in Europe as well as throughout the U.S.
Well, I'm very interested to hear that. In case you didn't know, I speak fluent Japanese and ran a division of Universal Studios doing all their development work in Tokyo for 10 years. So I would, if you need somebody to carry your bag, I would love
Oh,
to.
I'm definitely going to pick your brain and get your advice. That would be great.
I'd be delighted to.
And I think the last thing I would say is, we have quite a few now family offices and high net worth investors as well.
Mm,
We launched an opportunity zone business in 2021. We had a number of assets that we had under control and we were preparing to build on, but they became designated opportunity zones, so it didn't make sense to use tax exempt investors. So we launched that business and have built or building about $1 billion worth of assets throughout the West in that format, and we're kind of
mm,
excited. There's some really interesting opportunity zone provisions and kind of revitalization of the program in the tax bill that was passed this summer. So, starting in 2027, when those kick in, we will kind of relaunch a opportunity zone program for high net worth investors.
That's interesting. Are you finding that high net worth investors are holding fire on sales in anticipation of January the 1st, 27 and that 5 year tax deferral period? Or are they acting, is it not influencing? It's too far off, is it?
I think it's too far off. What makes it interesting is the way the bill's drafted. 26 is a little bit of a dead year. There's not a lot of benefits to investing in opportunity zones 26, but a lot of them kick in starting in 27. So,
Mhm.
we won't even tee up any deals until 2027 when it makes sense for our investor base. But
Mm,
we think it's pretty robust, and they've kind of broadened the program and they've streamlined the program in a way where I think it's even going to drive more investment to these opportunity zone communities, but really have a kind of a significant tax advantage for investors that qualify.
mm. So what are actually, I mean, this wasn't a high priority topic, but it is interesting, nevertheless, the OZ stuff. So what are the biggest differences? It's kind of high level. You mentioned some streamlining.
I think the biggest difference is that it's a rolling program. So when they passed the
Mm,
first opportunity zone program, you basically had a number of years before which your taxes were due, and then you got a discount on your taxes depending on when you invested. But it sunsetted. So the closer you got to kind of 2026, the less benefit there was for you. The new program is a rolling kind of evergreen program, which will make it much more consistent and much more
Mm,
stable and more institutional, frankly. So that's a major change, and there's some change about the kind of character of income. There's more income sources you can use for opportunity zones. It's pretty, we're pretty excited about it.
really, beyond capital gains?
That's our understanding. Yeah, that there's other categories of potentially ordinary income as well. And everybody's, as you know, with these bills, they often pass them in theory, and then the Treasury Department writes the regulations. So it usually takes a few months. That happened with the first Opportunity Zone program as well. So everybody's kind of working with Treasury, trying to understand exactly what it means.
Mm,
And they have some time because really it doesn't kick in into 27, but it's a significantly broader program, and
mm,
the evergreen rolling nature of it really makes it more useful for
mm.
investors.
Okay, so getting back to the fairway, you were talking about equity partners. So
Yeah.
how are you seeing equity and debt behave at the moment, both in terms of pricing and availability? And how's it actually affecting your pipeline?
Yeah, so we have we have something like 40 assets. So we're working at all stages. We have new developments, we have new acquisitions, we have stuff we've built and owned for a number of years. Then we've had stuff that we've bought in is in some sort of rehab program. So we see a lot of different things. I'd separate equity and debt. And starting with debt first, I'd say that the debt markets are very robust. You've
Right.
really seen spreads come way down. I just heard someone from a debt fund say that in kind of his 30-year career, these are the kind of lowest spreads he's ever seen. There's a ton of capital was raised in the private credit market, and a lot of promises were made about how that capital would be put out, and now people are really scrambling to do that. So we
Mm,
love that as the beneficiary of those loans. We love seeing those low spreads. It drives even better returns for our investors. We've also seen the big traditional banks who maybe set out a couple of years because of capital reserve requirements and other things. You're seeing them kind of run back into the space and say, hey, we're open for business. We want to be doing debt again. We're not going to cede this whole business to the private credit market. So, it's pretty encouraging as a developer and an owner and operator to see the availability of debt. And we're blessed. We've been doing this for over 2 decades and have a lot of money center banks as well as debt funds who we've done many loans with over the years, and so I feel like we're able to get really attractive financing for our projects. And then kind of pivoting to equity, it's been interesting that it's been a tough fundraising environment through COVID, and as interest rates
mm,
rose, and a lot of people tell you it's one of the toughest fundraising environments they've seen in a long time.
mm,
There was a lot of optimism at the beginning of the year that we turned the corner, that people were tired of sitting on the sidelines. They were unshackled and ready to go. And I think there was a lot of optimism in the first quarter. And then Liberation Day hit in early April, and it threw everybody for a loop. And a lot of folks pulled back. A lot of international investors pulled back. Good luck getting the Canadians to try to invest in the U.S. right now. They're not so happy with us. Although, when you talk to a lot of folks, they'll say, look, but it's such a big market, we actually have to invest. So we're gonna find a way to be in the US.
mm,
And then, but I would say since the summer, things have calmed down, and I think the tariff bark was worse than the bite.
mm,
A lot of capital come back in on the discretionary front and with institutions, but on the joint venture front as well. We've seen a lot of interest in our deals. There's development capital out there again for a number of years. Nobody wanted to talk about development because the thinking was, look, if you can buy existing assets at a deep discount to what you could build them for, why would you build something new and take the additional inherent risks that come with that? Um,
mm,
but now, value add deals have become more competitive. Cap rates are coming down, in key markets, not all over the country, but in a lot of these key supply constrained markets. And with that, you're seeing development yields become much more attractive. So we are seeing pretty significant capital flows back into development, and that thrills us because we have a bunch of we've been entitling over the last 2 or 3 years, waiting for the right time to kind of throw the switch and take them vertical. And I'm really happy to see that capital is excited about doing that.
So what kind of capital is interested in that?
These are, I mean, it's the biggest name kind of asset managers and funds that you can think of. And it's
Mm.
insurance companies. We
Really?
find they're very interested. They're interested in the debt as well. They'd also like to get their debt products out there, but they're interested in doing that.
Mm.
Um, I think you're seeing that with some foreign investment, particularly as you mentioned, the Japanese, like
Mm.
Japanese are not afraid of development and they understand there can be real kind of increased, returns and risk reward
Mm.
returns for that product type. So it's pretty robust across the board.
Okay, you touched on tariffs.
Hmm.
You didn't mention immigration, but what has been the impact of tariffs and immigration actually
Yeah.
on the market?
Sure, sure. I'll tackle them separately.
Mm.
We were very concerned about tariffs as someone of, about half of our business is development, versus buying
Mhm.
existing. And so we were really concerned about the potential impacts to cost. And we just finished entitling a 500 unit project here in West Los Angeles. I think it's the largest project that's ever been entitled on the west side of the city. Uh,
Mm.
Took us 4 years and 40 community meetings. LA is not easy, but it's really an unbelievable location. And we had, right before we had to make the final decision to buy the land, we had it in an option structure. Liberation Day happened, and we had plans and bid from general contractors, and we really stress tested that specific deal with the kind of worst tariff rhetoric. Like if the worst things happen that's being talked about, what kind of
Mm.
impact will that have? And not only did we talk to our general contractor about it, but my head of development got on the phone with the 17 largest either subcontractors or materials providers to talk to them about their business. How does it work? How do tariffs affect you? What are you seeing? What are you projecting? Um, and overall, it was about a 2.7% increase on the hard cost budget and only about a 1.5% increase on the overall budget, because obviously it doesn't affect land and some of your soft costs.
Mhm.
So, that's impactful, but it's not devastating. And we've
Mm.
also seen construction costs come down in a lot of our markets because
Mm.
you're not delivering supply, people aren't building as much, and subcontractors are hungry and they want to work. So overall, it's been kind of a big nothing burger from a from a cost standpoint. Like that doesn't mean
Mm.
we're not vigilant. We don't stay on it. We're on the phone, daily or weekly with our different subs across all of our projects because we want
Mm.
to stay ahead of it. We feel kind of quite good about the kind of limited impact of that. And then turning to immigration,
Mm.
the thing we were concerned about. Obviously, we employ, 200 people here at Cityview, but hundreds or thousands work on our projects. And we are a larger development firm, so we work with the bigger bulge bracket contracting firms, and we have very strict rules about complying with U.S. law and complying with local laws, et cetera. But so we haven't seen any impact on our existing projects. Had an interesting anecdote. One of our subcontractors, who's large, and they will remain nameless, but on a different project, they had 300 people working, and they got raided by ICE. And this was 2 or 3 months ago when LA went through the kind of heaviest of the ICE raids. And out of the 300 people they had working on site, they said four of those 300 didn't have appropriate paperwork and were removed from the site. The other 296 kind of had legal documentation. So, again, if I was in the single family home business, I think that business probably has more undocumented workers. But for the kind of bigger, multifamily projects that we build, it hasn't been a major issue. I think it has other impacts on the communities that we're in. It's, created kind of a climate of fear, which is unfortunate. And so I think there's other challenges with it, but we haven't really seen the economic challenges on the construction side to date.
Okay, and no demand. No, you've not noticed any demand impact. I mean, you're in LA, right?
Yeah, I'd say, yeah, I mean, like, we're all over, but since we're building brand new, kind of class A projects, we're not seeing any demand. And like, but we're throughout Silicon Valley, we're in other areas, so we're keeping a close eye on the visa programs to make sure that there's not a dip in workers. at that level. It's probably more white collar than blue collar for most of our projects, but that's something, we kind of track closely. And again, we do that through obviously tracking reports in the media, but we're also having a lot of conversations with business owners and others about what they're seeing to try to stay ahead of it as much as we can.
All right, before we get to Los Angeles specifically, and it is a topic I'm very interested in talking to you about, um, let's talk more macro. So was it Marcel and Alvarez, right, came out with a report recently predicting that the banking deregs that are going through at the moment are going to release $2.6 trillion of capital
Yeah.
into the market. Okay, so that's point one. On top of that, and you may disagree with me completely, or then, but on top of that, there's an inevitability and signals, in fact, coming from the Fed now, but the inevitability that when, if not before, when Powell turns out in May, interest rates are going to come down. Who knows how far?
Yeah.
Right, exactly. So we've got massive amounts of liquidity likely to be flooding into the market with regulations that are pre-GFC, Great Financial Crisis kind of regs. Does this give you cause for optimism or concern?
It gives me cause for optimism generally, but with a, kind of with a caveat. They used to say cautious optimism. Maybe it's like nauseous optimism on this front.
Nauseous.
Yeah, we look, we're a business that relies on debt and financing and capital. You can't build real estate and operate real estate without that. So critical importance. So I think thoughtful, regulation reform, right, it is helpful, right? It floods more capital into the market, which is important. That's going to bring costs down, building costs come down, rent costs come down, et cetera. So I think that's a positive. And it's, we would love to see the Fed lower rates. We've been waiting a long time. So I think, I hope it's done not for political reasons, but it's done for economic reasons based on the data. That's our hope. But I think the cautious or nauseous part is, if inflation goes up, right, because we flood the market with too much capital, then the 10-year is going to go up, and the 10-year bond is really what everybody focuses on in our business, in terms of the kind of cost of risk-free capital, right? And so, and cap rates are related directly to that and other things. So, I hope that the capital coming into the market will be a positive. It should be, but if it's overdone, if we look like 2006 or 7 again, where we really take any sort of regulations off, and it just becomes the wild, wild west, that can have real consequences. And as we saw in the Great Financial Crisis. So I think there's more controls now than there used to be. I think the banks are in a much, much stronger place than they were in 2006 or 2007. So we're not predicting that, but I just hope it's thoughtful.
Yeah, interesting. I spoke to Erica Groshen, who was a former commissioner of the Bureau of Labor Statistics a couple of weeks ago for the podcast, just because that suddenly became headline news. So I figured I'd speak to a commissioner. And she also agreed with this idea. At the time, Marcel and Alvarez's study had not been released. So we were just talking about interest rates and general stimulation of the economy. She described the likelihood as being a sugar rush, that there will be a burst of enthusiasm that will then be followed fairly swiftly by a hangover. Do you think that's a reasonable perspective?
I think there's a danger of that. So I think we need to be careful about that. I do feel like there were a lot of lessons learned during the Great Financial Crisis, and this generation has lived through that now. Not the younger generation,
Right.
but not them, but a lot of the managers have, and a lot of the people on investment committee have, and I certainly think differently about real estate. Having gone through the GFC, having gone through COVID, having gone through the interest rate spike of the last 3 years and the inflation spike. So, we're not hearing like irrational exuberance, to borrow Alan Greenspan's phrase. We're not hearing that from our investors that we talk to. But I do think there is optimism. People are hopeful. The economy has seemed to be surprisingly resilient going forward. I mean, in the past, and so I think there's some optimism going forward. Look, I think the macro concerns, people are concerned about. I mean, obviously the impact of AI No one really understands what it's going to be. There's opinions all over the map, but I think what everybody agrees on, or most people, is it's going to be a significant impact. And how is the economy going to shift and how's it going to change based on that. So that's something that we spend a lot of time trying to think about and talk to people about and read about. And then we look for clues at our projects. Having 40 operating assets in these markets, we have some real-time data, and we use AI to analyze it to see what kind of trends about AI we can figure out. I think that's something people think about. And look, there's a lot of talk about Fannie and Freddie privatization.
Hmm.
What does that mean? Fannie and Freddie are the largest providers of liquidity, right, to
Hmm.
our business. And so, what are those changes going to mean? Is cost of capital going to be more expensive? If that is, that's going to impact some of these other good effects. But it's hard to tell like what's real and what's not. I've been reading about a lot. All the big investment banks have been parading through the Oval Office, doing a bake-off on who should handle the IPO of Fannie and Freddie. But I think we're all watching to see like what does that actually mean? What's actually going to happen? But that could have an impact on our business as well.
Okay, so just continue this theme just for a couple more minutes. You talked about yes, cautious optimism and the possibility that there may be a sugar rush and then a hangover afterwards. And you talked about being careful. What does that mean actually? When you talk about it's like how do you actually make decisions? How do you underwrite differently if that is your viewpoint coming up today?
I mean, I think that this has always been our philosophy, it's really been hammered home by some of the downturns and challenges we've seen in
Mm.
the last 2 decades, which is it really does start with the real estate. And is it a good real estate deal? Where I see a lot of people make mistakes is they get caught up in a financing scheme or a mechanism or an interest rate. And what really drives the deal is not the fundamentals. It's not good real estate. It's near jobs. It's near transit. In supply constrained markets, it's driven by a financial structure. It's driven by, some deal that somebody can get. And I think that when we lose focus on the fundamentals, bad things can happen because structures can change. Financial structures are very easy to replicate. You do not have a sustainable competitive advantage as a firm just because you structure things in a certain way. So, I think as long as investors and developers and operators keep focusing on fundamentals, which was what we strained to do, I think you'll make better decisions. People are going to make mistakes. Markets change. We can't control that. Vintage matters, cycles matter, but I think the more you stick to the fundamentals, you minimize those impacts to the best that you can. They get really amplified bad impacts when you just based your value on structure. So I think people need to be kind of smart and thoughtful in that sense.
All right, let's come back home to Los Angeles and in this context.
Yeah.
So there is clearly a housing supply crisis or housing crisis in America. On the one hand, though, some markets are oversupplied, and we're seeing rents slipping, and it's having significant impact because of oversupply and overbuilding. And then on the other hand, there are markets like Los Angeles that are woefully undersupplied.
Yes.
So my question is this. It's a double barrel question, and I know you don't mind those because you've split up all of my prior double barrel questions quite effectively. So here we go. What can local governments do to solve the supply problem? Specifically, let's talk about LA. And two, what can the developer in the White House do to
Yeah.
overcome local reticence?
Yeah. So the first question is easier than the second. And so I would say that at a federal level, and I sit on the real estate roundtable in Washington because I feel like it's one of the best organizations that focuses on kind of housing and real estate issues at the federal level.
Mm.
The federal government, I think, has struggled to figure out what's the right role for it to play in this crisis. Obviously, you have Fannie and Freddie, you have the financing arm. They can create things like opportunity zones, which can flow capital into real estate. There's tax policy, right? 1031 exchanges and those kinds of things. But I think the federal government has been reluctant to weigh in and override states or local municipalities, cities, et cetera, on on a lot of the issues that prevent housing to be done because people say housing is a local issue. And I think it is generally a local issue, but I think if local governments fail enough and you have a crisis, then you need the state or the federal government to step in. And so I'm hopeful the federal government can play a more productive role in encouraging more housing to be built. Um, I would say in what local governments can do, and like we see this in Los Angeles, is it's a couple things. One is they can reduce costs of housing. I mean, the more you add permits and fees and um, in lieu fees and linkage fees and all of these things to a project, the more cost to build, and you just have to charge that much more in rent in order to make minimum returns. And it's something,
Or you don't build.
or you don't build, or you build somewhere else. I was explaining this to some of our elected officials in LA a few weeks ago when we had a meeting. I was saying, because their argument is LA is great, everybody wants to be here. And I said, look, if LA is great and people see the benefit, they like our educational system and what we turn out from our universities who graduate more engineers than anywhere in the world. We have a incredibly diverse industry with people think just about entertainment, but we have gaming and we have tech and we have healthcare and we have a whole space, new space, aerospace, and now defense is coming back, right? People are spending more at the national level on defense, which benefits Southern California. So people believe in all that. But when you keep adding additional costs and you make it too expensive, or you create too much risk because every week your city council is coming up with some new kind of scheme that's crazy, investors go elsewhere. And I said, look, when we go to raise capital for one of our deals, our investors are not just saying, do I build this deal or that deal in LA? What they're saying is, I could build a data center in Virginia. I could buy a mall in Berlin. I can invest in industrial in the Midwest, or I can build housing in LA. Like they're going to look at the risk adjusted returns. And one of our biggest, most sophisticated investors said to me, we love LA, and they went through all those things I just talked about and more. And they said, but there's just a level of political risk in that city that we don't get paid to take. So, any deal is going to be that much, kind of a higher standard to do there. And that's a story that we tell to electeds a lot. I haven't had much success.
I was going to say, do they listen seriously? I mean, you've also talked about, wanting to persuade local government with data, right? Are they, and I know somebody may be listening, so obviously we want to be diplomatic, but are they persuadable, or is the motivation somewhat completely misaligned with the realities of supply demand in this industry?
Look, you can't be a developer if you're not an optimist, Adam, and I'm an optimist, and I think they are potentially persuadable. I would say we've had really good success at the state level. We've spent a lot of time individually as an industry through the business, business organizations like the Chamber of Commerce and the CEO Council, lobbying in Sacramento on housing reform. And I think we've seen these kind of historic bills passed in the last 3 months that have been the most fundamental changes in land use in kind of 5 decades in California. And that's because I think they were ultimately persuaded by data. There's some new kind of intellectual frameworks about, out now that give, I think, Democrats cover, like the abundance agenda, which is all about, addressing scarcity by building more. It's about permit reform and those kinds of things. And, more of a recognition that it is a supply and demand imbalance. So that's good. Look, at a local level, we've made some progress, but it's a fight. And also because at the local level, people hear from communities, they don't, they hear from homeowners who say, I don't want any density in my neighborhood. I don't want affordable housing in my neighborhood. So they're hearing that at the local level as well. And so it's even harder to persuade them to green light, more projects and to make housing easier to do.
So there are some cities that you could point to as examples of having good policy, aren't there? Like San Diego or Miami. You've also mentioned Beverly Hills, but that's kind of a really tiny microcosm. But so what are the key policy shifts that we can learn from these towns?
Yeah, look, I would say, San Diego is a great example. Mayor Gloria has put forward a pro housing program there, complete communities. He designed something that was very innovative. He went in community to community to kind of sell it to local communities. And it's dramatically increased the certainty and predictability of getting entitlements. And we're doing, we have two projects. We're going to do 1,000 units of new housing in San Diego. Um, and because, there's some predictability around what we can build and how long it's going to take. And they give you comments in 30 days when you turn something in. That's unheard of. They thank you for, you go see the mayor, and the mayor thanks you for investing in the community and thanks you for doing business. And you don't hear that in a lot of communities in California. And it's really made a difference. And he's created a narrative of this is a city that's, willing to lean in to get housing done. And look, there's requirements like we have to build affordable housing as part of that, right? I think, we're going to do 150 or 200 units of affordable as part of what we're building, that are available to people who make less than the average income in the entire city. But that's okay. We can do that as long as we know what the rules are, right? And we can do that as long as they speed us through planning, and it takes 9 months or a year, not 2, 3, or 4 years, because that all is expensive and that all needs to get passed on to the renter. So I think there's leaders like him who are forward looking, and again, they're protecting the community, they're building affordable housing, and they're doing it in a thoughtful way. But they're saying, look, we realize that the cause of these sky high rents is the fact that we don't build enough, and we're going to change that. So I think there's models out there for doing it. They're not easy. They take political courage, they take will, they take a lot of effort. But I think the cities and the communities really benefit when they're implemented.
Sean, what a pleasure talking to you. I have a couple of questions that I want to ask you when we've finished. But before we do that, two final questions.
Yeah.
What is the biggest misconception you think that investors have, both institutional perhaps, but also let's call them retail investors, about the current multi-family cycle, where we are in the cycle?
I think that for us, well, I think the biggest misconception a lot of investors have is they kind of focus too much on whatever kind of cap rate they're underwriting, whatever yield they're underwriting. And the reason I say that is, we often hear as we're out talking about deals, an investor say, well, I'm looking at another deal and it's in Austin, Texas, and I can get a better yield on that. Right, I can get a better yield on that than what you're building in San Diego, for example. And what we explain to them is, rents are down 15% in Austin, Texas year over year because they delivered 30,000 units. And that's good for the community, right? Rents come down, but it's not good from an investor standpoint. And that, the biggest misconception is, I think, sometimes not understand the value of being in supply constrained markets as an investor. And we saw this for many years, for 10, 15 years, people thought CityView they would say, you guys, it's incredible. You've accessed all these hard California markets and you're a genius and California's so great. And then COVID hit. And those same people said to me, you're an idiot. Why would you ever invest in California? No one's ever going to live there again. Everybody's moving to Texas and Florida. And now in the last year, people are calling again saying, actually, we've seen a ton of resilience in our California markets. We're seeing rent growth. We're seeing, economic growth, and no one's building any supply. So we want to be back on the coast again. I just got off an investor call right before this where they said, we totally pulled out of California. Now we're back. We think it's the best opportunity. So I think there's a misconception about what really drives value. But generally, I would say, people seem to be pretty bullish on multifamily. Most people understand that, there's 7 million plus, too few units of housing in this country, half in California. And then if you can, build it or own it in good markets, it should be a solid investment.
Okay, last question. You talked about being cautiously and nauseously optimistic. I'm not quite sure if I'm mixing all these terms in the right place, but anyway, cautiously optimistic. Let's go with that. So what are the signals for I'm presuming for the next 12, 18 months or so. So what signals are you watching to assess whether or not that optimism, cautious or not, is correct?
Yeah. So there's a bunch of different signals, but we really focus on all the demand indicators, right? Are jobs being created? What kind of jobs are being created? How's consumer spending? Are consumers excited? Are they nervous? That's obviously a leading indicator. of what's happening in the market. We're looking at, I mean, we look at so many different, we're looking at IPOs. What's that IPO window like? Is it open? Is it
Mm.
closed? That affects the very specific markets that we're in the Bay Area. But I think we do focus on the demand side quite a bit. But we do that because we're really only in supply constrained markets, with maybe the exception being Dallas, which is not as supply constrained, but the demand numbers are so strong. When you're adding 400 people a day, you can kind of override some of the supply concerns. So we're spending a lot of time looking at that. And look, I spent a lot of time, not just reading everything I can get my hands on, but I'm talking to our investor partners. I'm, talking to our bankers, and I ask a lot of questions. I mean, maybe I should have a podcast like you, Adam. I wouldn't be as good at it as you are.
You should. You'd be great. You'd be perfect.
I'm going to leave it to you and the professionals, but I'll say that I ask a lot of questions. I do a lot more listening than talking, and then we get together with the team here, and we're kind of pulling all that information together and talking. And I was trying to get a feel of where we're headed. So that's but we are optimistic. We think there's not enough housing. So as long as the economy keeps chugging along, and as long as we can finance the projects, we think that should lead to good risk-adjusted returns for investors over time.
Sean Burton, CEO, Cityview. What an enormous pleasure. Thanks so much for joining me again today.
It's always a pleasure, Adam. Thank you for having me. I appreciate it.
Right, that was Sean Burton, CEO of Cityview. Sean, what an enormous pleasure to see you again. Thanks so much for spending your time with me. We chatted a bit afterwards about the power of podcasts, even over being quoted in the Wall Street Journal. It's absolutely true. I mean, what we didn't talk about was the fact that, okay, so you quoted in the Wall Street Journal, but hey, guess what? It's in the paper today and gone tomorrow, right? Whereas podcasts, oh my goodness, you have all these micro influencers, micro and nano and some mega influencers who are broadcasting your message out there, and it just stays there, right? Somebody else subscribes to their podcast and they listen to all prior episodes, and so it's just an incredible resource. And like you say, it's also a lot of fun. So I'm glad you think that way, and I'm glad you joined me again today. So thank you, and thank you to dear viewers and listeners for joining both of us today on the show. Without you, it couldn't be possible. And you know what? Connect with me on LinkedIn. If we're not connected on LinkedIn yet, just go to LinkedIn, search for my name, Adam Gower, obviously, or Gower Crowd. I should pop up and connect. I've been hyper active on LinkedIn. I really enjoy it, actually. Find it a very creative place to be talking about ideas and thoughts and insights into what's going on in the market. So anyway, it'd be great to see you over there. Connect with me, and we can chat online. I don't think of LinkedIn as being social media. I think of it as being business casual media, right? So anyway. All right, that is it for this week's episode. Thanks so much for joining me. And until next time, this is Adam Gower signing off.